How to invest your IRA. Learn these baby steps to figure out how to invest your IRA and grow your portfolio in no time. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing wonderful, if you were to ask. If you're doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to invest your individual retirement account, aka IRA. Number one, hire a pro if you aren't one. So if you have no interest in selecting investments or have no financial literacy, you want to outsource this to a professional. This is very important. Now you can do this, two ways. All right. You can basically go reach out to a person, to a human being at a mutual fund or at an asset management firm. You can actually hire a financial advisor to sort of, push you into the right direction. That's the human part. Or you can just select what they call robo advisors. In other words, those are algorithms that will automatically invest for you based on pre-selected criteria. Now, the thing here is that you have the ability to set those criteria from the get-go. All right. So to use a robo advisor, you would need to open an IRA account at one of these companies, right? The companies where, again, there are several brokerages out there. You can choose the one that you like. And again, this depends on your personal situation. That's why you want to reach out to a financial advisor first. All right. So, those brokerages can indicate to you what kind of robo advisor you need, right, when it comes to managing your mutual fund or ETF portfolio for you based on your age, risk tolerance, and other factors, right? Again, so ETF stands for electronically traded funds, right? Now if you go to a normal brokerage, the same process applies. So for instance, I'm talking about Fidelity Investments, Charles Schwab, Templeton, Franklin Templeton. You have a lot of them out there. So you got to just start thinking about what's really important for you. Now, no matter what you do, whether you go the human way or the robo way, if you will, take steps to minimize all types of investment fees, right? Because those fees, if you don't check them, often if you don't track them, they can start to swallow your portfolio's return, right? So you want to make sure that your individual retirement account offers competitive commissions and abundant low-cost investment options. All right, now let's take a quick look at when I'm talking about fees. What am I really talking about here? Let's look at a quick list of investments and brokerage fees. So what is a brokerage fee? A brokerage fee is charged by the broker that holds your investment account. So if you were to open an account at Fidelity might charge 0.5% or 1% of your assets as a fee every year, right? So brokerage fees include annual fees to maintain the brokerage account, subscription for premium research or investing data, fees to access trading platform, and sometimes even inactivity fees for infrequent trading, right? Because they want you to trade. That's how they make money. They make money on the spread. They make money also by making sure that your money you're trading in the account that you're probably borrowing from them in the sense of a margin, right? So they really want to make money. That's why you have to choose the right broker so you avoid brokerage account fees. Now, besides the brokerage fee, you have something called trade commission, right? So this is also called a stock trading fee, right? So this is charged when you buy or sell stocks, which, as I was telling you earlier, they charge you a fee for infrequent trading because they're not making money off of you through trade commissions, right? So you may also pay commissions or fees for buying or selling other investments, right? I'm talking about ETFs. I'm talking about options. So you have a lot of fees there. Now, ETF, as I said earlier, they're not electronically traded funds. They are exchange traded funds, rather. My fault. So, ETF stands for exchange traded funds. Now, you also have mutual funds, right? So, and you have a mutual fund transaction fee. This is charged to you when you buy and or sell some mutual funds. you have something called expense ratio. Now, this is usually charged by mutual funds, index fund, and ETFs. This is a percentage, they charge this as a percentage of your investment in the fund, right? You also have the sales load. This is a sales charge or commission on some mutual funds paid to the broker or salesperson who sold the fund. So this is commission going back to the salesperson. Now that's taken from your account. Now you also have the management or advisory fee, right? This applies usually for the AUM, the asset management industry. So it is a percentage of asset under management, and you pay this. If you're an investor, you pay this, to a financial advisor or a robo advisor. And last but not the least, you have the 401k fee. This is typically an admin fee. This is an administrative fee to plan, to maintain the plan. And this is often passed on to the plan participants by your employer. Now, you have to understand that the reason why I'm taking some time to explain to you the investment and brokerage fees is that if left unchecked, an investment and brokerage fees can affect return in a significant way. Let me give you a quick example. Let's say every year for the next 20 years, your portfolio is returning on average 10%. And you're paying fees and expenses to the tune of, let's say, 3%. Over 30 years or 40 years, that means that you are making, instead of 10% on average, you're making 7%. That's huge. On an annual basis, it might not sound too much, but if you compound the 3%, those 3% over 40 years, that's a lot of money, which is why you want to reduce as much as possible the investment and brokerage fees. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. We are continuing our conversation about how to invest your IRA. And if you like the content clarity and quality, please consider subscribing to our channel and turn on the notification bell so you can receive our shows, new shows every single day ASAP. And comment below, like this content, and share if you think this could help someone else who is trying to understand IRAs and how they can invest their IRAs. The second thing you want to do is you want to figure out if you are a risk taker or risk adverse. This is a conversation that all investors must have at some point in time. Whether they are individual investors or institutional investors, you need to identify your risk profile. You want to see where you stand on the risk continuum, right? So if you are a risk taker, there are certain investments that you should seek for your IRA. Conversely, if you are a risk averse person, there are some investment that you should avoid, right? So risk takers can invest in bonds, stocks, ETFs, options, mutual funds, complex instruments such as foreign exchange, commodities, right? And to determine what really matters for you, you have to think about your age, to think about how much you're making, your earnings. You have to also think about the time horizon, right? So if you are 30, your risk level is not the same thing if you are 40 or 50, right? If you are a risk averse person, you might want to go with bonds, fixed income products. You want to be very safe. So when it comes to portfolio allocation, you can probably do an 80-20. So 80% fixed income products such as AAA rated bonds or treasury bills or treasury bonds, right? And if you are a risk taker, you might want to go, you want to do 80-20 with 80% of your cash invested in stocks and other highly volatile but profitable instruments, and allocate the 20% of the company of your portfolio to fixed income products. So it is a personal decisions that you have to think about, and you have to think about your age. As I said earlier, it's very important. You want to be mindful of your age, because you want to take more risk when you're young and then taper down as you inch towards retirement. Remember that people live longer these days, but again, we still have to think about how to maintain a profitable portfolio over the long run. This is very key. All right. Now, the third thing you want to do is you want to use various mutual funds to constitute your portfolio. This is very important. If your goal is to constitute a great portfolio, you want to diversify, right? Don't fill your IRA with individual stocks and bonds, right? It's not the best approach for anyone but a professional investor. It is much easier to get diversification and over the long term better results from a portfolio composed of mutual funds and exchange traded funds, aka ETFs, right? Remember that ETFs again, or ETFs as well as mutual funds, are they are aggregates of individual stocks and bonds, and they are very diverse, right? You can even go with a general index fund, for instance the S&P 500, right? They invest in some of the largest US companies, right? Now this could be some investors might call this a large cap fund for the fact that it has companies that they have a higher capitalization, right? They're highly valued. So you want to allocate more of the equity portion of your portfolio to the biggest asset classes, right? So for instance, if you love technology, go for a safe bet, right? Go for Apple, Amazon, or Facebook. Go for something very safe. And if you're going towards the bond spectrum of the investment equation, trying to go again for very safe companies, right? I'm talking about global companies that have liquidity, that they can pay off their bonds. We're not giving in this show investment advice, though. This is a disclaimer that I wanted to say, but this is more of a general information show. We are an infotainment show, information and entertainment, but it's up to you to make your personal decision after considering your personal situation, right? So you want to think about all the factors that matter to you before making a final decision. It's very important. Okay, I will be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweaty Kiwi. We are very happy to have you here, and let's continue on a very interesting topic: how to invest your IRA. Now, understand asset allocation, right? You might be thinking, oh, wow, asset allocation, that's a complicated phrase. No, it's not. It simply stands for how your money is divided among different types of investments, right? Investments, I'm talking about stocks, cash, bonds, right? This is if you think about it in terms of asset classes. Now, you can also look at asset allocation through a different lens. For example, you can think about large cap stocks versus small cap stocks, right? You can think about corporate bonds versus municipal bonds, or corporate bonds versus government bonds, what they call sovereign bonds. Right now, by cap, I'm talking about capitalization. So large cap stocks means large capitalization stocks. All right. So this is very important to think about it. Now, let me just dig a little further into asset classes, because the idea behind asset allocation is to help you diversify your portfolio so you don't put all your eggs in the same basket, right? So example of asset classes include cash, right? So this you can put your cash, to work for you in a money market account. You have bonds. Bonds can be investment grade or junk. Junk bonds are the one that have a high yield but also very risky. You have government or corporate bonds, short-term, intermediate, long-term. You have domestic, foreign, emerging markets bonds. Stock can be classified as value or growth stocks. Large cap versus small cap. I already said that before. It can be foreign stock or emerging markets. It could be real estate. Real estate is an asset class. Foreign currencies. So if you invest in the forex market, you are investing in currencies. Natural resources. This is basically commodities. Precious metals. Also part of part of it can be commodities. Luxury collectibles, right? I'm talking about wine, fine wine, automobiles, art. We actually did a show about how to invest in wine. You might want to check that. It's very interesting. We have received a lot of good feedback. People loved it and they wanted to start investing in wine right away. So you might want to check it out. When it comes to asset classes, you also have real estate investment trust called REITs, international investments, that's foreign or emerging markets, and life settlements. Now, when it comes to asset allocation, there are different strategies that are used in the industry. You have something called dynamic asset allocation, strategic asset allocation, constant weighting asset allocation, and tactical asset allocation. Now, we have an entire show that will be dedicated to this various strategies. Just know that right now the most important thing for you is to talk to your advisor, or talk to your banker, or talk to your wealth manager about the best asset allocation that is good for you if you're not a professional yourself. And you what's very important is that depending upon your age, let's say if you're in your 20s, or if you're in your 20s or 30s, you might want to go for the dynamic asset allocation. You want to basically constantly moderate the mix of assets as market rise and drop. So because the dynamic asset allocation allows you to sell assets which are losing value and buying those assets which are gaining, right? So it's basically the opposite to a constant weight scheme. But again, I'm not going to go too much in detail here because we have an entire show that will be focused on this particular asset allocation strategies. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Sweetie Kiwi Show. We are about to wrap up today's show, and just going to give you a reminder of what today's conversation is about. I've given you baby steps to figure out how to invest your IRA and grow your portfolio in no time. Now, let me give you the four baby steps that you can use. Hire a professional if you aren't one. Figure out if you're a risk taker or risk averse. Use various mutual funds to constitute your portfolio. Understand asset allocation. All right, now, before we wrap up the show, let me give you a call to action. Our call to actions are usually geared towards making sure that our viewers and listeners can implement actual stuff. They can take something from the show and start living off of that and start benefiting from the advice. So what I want to do is that you want to focus on starting today, right? Contribute to your 401k and make sure that you meet your employer's match, right? Open an IRA, and take care of catch-up contributions if you are 50 years old or older. Automate your savings. It's another very important. You want to make sure that you don't even monitor, you don't even know what's going on. Things are just happening automatically in the background. You want to limit spending, set a financial goals. You want to stash extra funds in a rainy day account or an emergency fund. And most importantly, consider delaying Social Security as you get closer to retirement. And I'll explain this to you in another show. But yeah, this is very important. There are some taxes and tax ramifications and financial ramifications when you do that, when you take Social Security early. All right. I'll be talking to you another time. And until then, stay marvelous.